Investing in real estate abroad sounds exciting. Sunshine, seaside, maybe even better yields. But here's the thing. German property quietly beats a lot of those hot markets, especially when you look at the full picture. In this video, we will break down why Germany still offers lower interest rates than many other countries, how you can buy property here with surprisingly little equity, and how smart tax strategies make German property far more efficient than most people think. The key is to stop looking at just the surface, price, yield, hype, and instead take a truly holistic view, because that's where real wealth is built. Let's get started. Most people make the mistake, if they look at property, that they only look at one criteria. So for example, they say, yeah, here I have the highest tax benefits, there I have the highest appreciation, in another country I have higher rental yields. But this is not enough to look at the property, or let's say to evaluate the property and the investment in general. Because it might be the case that you have in one country better rental yields, for example, but no tax benefits at all and a lower appreciation rate. Does it mean now it's better or worse? Well, it depends, obviously. So the most important figure, or let's call it yield, is the following. This is called yield on equity. Okay? This is what 99% of people don't get when it comes to real estate. It's yield on equity. So how much profits do you generate in comparison to the equity that you have invested? And this makes Germany super special, because if you buy a property, let's say for 500,000, you need, it depends, let's make it easy, 40K in savings to buy such a property. It might be a bit more, it might be a bit less, it depends on the federal state in Germany, okay? So you need to invest 40,000 euros in equity to buy the property. Let's compare it to another country, for example, let's say this is Germany, and let's compare it to the UK market. So in UK, it's often the case that the bank wants to see 20% in equity, which means you need to invest 100,000 euros to buy this property. So even if you might have higher rental yields, even if you might have higher appreciation, the question is, do you still make more money in comparison to the equity that you have invested? Because in the end, the only question is when you invest money in general is how much money do you make in comparison to what I have invested myself? Okay? It's a better investment if I make out of 10, 20 in comparison to 20 to 30. You know, it's just a better investment. So we have 40,000 euros equity capital in Germany, in UK 100,000 euros. Now let's say you're a German resident. Now it's pretty likely that there is no possibility to invest in other countries, because they say, yeah, when you're not working in this country, you're working in Germany, so we don't give you any mortgage. Which means that if you buy this property for 500,000 in another country, you need to invest 500,000 out of your own pocket. Same applies to 200,000 euros. Because German banks typically only give you personal loans for, let's say, max 80K on average. So even if you buy a property for 200,000 euros back in your home country, you still have to invest 80,000 euros. So now you have higher interest on that. You need to pay probably maybe 6%, might be a bit more, might be a bit less. Okay, now you might have a higher appreciation rate in another country. Now you might have a higher rental yield. But now you're paying also 6% in comparison to Germany, where you pay 4% interest, but it's fully tax deductible. So you receive 42% back. So you actually pay, oh, let's do it differently. Otherwise, the math people will hate me. So minus 40%, let's do it like this. So we have 2.3 something net interest. So even if the rental yield is now higher, well, but you're also effectively paying 3.7% interest more. Now you get it, because if I just compare rental yields, and let's say you have in Germany rental yield of 5%, and another country you have rental yield of 7%, so you see, well, the other country is stronger. Yeah, but you're also paying higher interest, 6%, 2.3, plus you would have to invest significantly more equity capital. So the question is always, how much money do you make in comparison to the equity capital that you have invested? Okay, so it's really difficult to invest in another country. If you invest in another country, also we can discuss that example. Let's say you buy it in cash. You buy an apartment for 200,000 euros. Well, in Germany, I would highly recommend to not do that you buy an apartment in cash, especially if you want to rent it out. Okay? So we have 200,000 euros value. Now you pay it in cash. Well, first of all, you need the cash. But even if you have appreciation rates of 5% per year, 7% per year, let's call it you have 10% per year appreciation rates in real estate in that particular country, which is also pretty unlikely, especially that you have this appreciation rate long term. Might be the case that you have it for 3 to 4 years, for example. Okay? And now you say, well, I have 200,000 euros, I have appreciation rate of 7%, this real estate market is great. Well, then I would probably say, why do you do that? Why all that hustle? Just invest 200,000 euros in the stock market, generate 8 to 10% per year, and you don't have to deal with anything. It's liquid, you don't have to talk to any tenants, you don't have to manage the property. If anything is broken, you have to do a renovation. This is not the case with stocks. So we have learned it doesn't make sense to buy a property in cash because there are better alternatives. This doesn't make sense. It doesn't make sense to buy a property where you have to invest lots of equity capital yourself to even buy the property, especially in comparison to the German market. Because let's look at it from equity perspective. You have a property for 200,000 euros. Now my famous example, which I'm always doing. You need to pay, let's say 7% in equity in Germany. So you only invest 14K out of your own pocket. You have rent of 900 euros. You have costs of 1,000 euros, including maintenance, mortgage, management. So you invest 100 euros yourself. So you invest 100 euros times 12 months times 3 years, because you can increase rents in Germany by law by 15 to 20% if you do it correctly. Let's make it easy. You have 1,000 euros rent. You have 1,000 euros of costs, so you don't pay anything anymore. Okay? So 100 times 12 times 3 would be 3,600. We have 14 plus 3,600, so 17,600. Out of 17,600, you create a wealth of 200,000 euros in Germany in worst case scenario if I don't calculate with appreciation and I only include one rental increase. So we have factor 10x on equity capital. Now the question, and this is the only question, does any other investment in another country actually beat this performance here? And if no, even if you have high appreciation rates, even if you have positive cash flow upfront, you name it, it's weaker in comparison to the German market if you don't have at least this performance here. So it's pretty difficult as long as you're living in Germany to buy properties in other countries. Either you have lots of equity capital or you need to have, or you have significantly higher interest rates on the loan. You might have higher appreciation, but in the end, in total, I'm pretty sure in many cases it will be a weaker investment. Some people ask me, yeah, what about Eastern Europe? And I say, yeah, in Eastern Europe, you have higher profits, for sure, at least from rental yield perspective. How much rent can you charge in comparison to the purchase price? This might be true, but the question is, do you have to buy the property in cash or what? Do you take out a personal loan, for example, to buy the property? Yeah, okay, cool, you buy a property there for 80K, you have higher profits, but if you have higher profits on 80 it still might be weaker if you have lower profits on 500,000, you know, because of compound interest effect. So in my opinion, you don't have to worry about German real estate investments, and you shouldn't look at any shiny objects which might be shiny objects, and typically they are not that shiny. If you really look at the situation from a holistic perspective, you really compare. Let me summarize. So in Germany, first point, you can sell the property tax-free after 10 years. So this is also something we need to include in our understanding of that investment, because let's say you have higher profit before taxes, but if you sell the property, you have to pay, let's say 20, 25, 30% capital gains tax, depends on that country. You sell the property, you have to pay taxes. So the question is, how much money do you have net, also after taxes, and not just before taxes in any Excel sheet, you know? You can sell tax-free. You have lowest equity requirements. Let's do it like this. Probably in the whole world, you only invest 7% out of your own pocket, and that's it. That's unique. You can't buy in other countries where you just tell the bank, yeah, I'm paying 7% and you give me the mortgage. Then banks would say, yeah, the real estate market is not that stable. We have more issues with our clients because in Germany, people are paying the mortgages on time. You know the Germans, you know? Since they are super reliable, banks are easier and more confident in giving higher loans, okay? So we have tax-free 10 years, you have lowest equity capital, so therefore highest leverage when it comes to equity yields. On top of that, if you're in Germany, also after that, costs of a real estate investment are mostly tax deductible, so you can offset rental income, or let's say costs out of your real estate investment with your taxable income, so with your salary, for example. And these 4 points combined, I could now also mention security. You don't have these issues. Landlords and tenants are protected. It's by law, no one can claim it's now my house and take it from you, like in other countries, for example. You have political stability, especially in comparison to other countries, and so on and so forth. So if I look now at other investments and compare it like this from holistic perspective, I typically come to the conclusion that a German real estate investment would make more sense. Here is the bottom line. German real estate isn't flashy. It's solid, tax optimized, and built for the long game. With the right strategy, smart financing, and low initial equity, you can build a powerful portfolio right here at home. Most people compare foreign properties on emotion or lifestyle, but as an investor, you always have to look at the full picture. Financing, tax efficiency, long-term appreciation, cash flow over decades, and so on. If you want to learn how to build that kind of smart portfolio, hit like, subscribe, and drop a comment. Would you rather own a flat in Berlin or a beach house in Spain? Let's talk numbers.